Financial terminology is often treated as a specialized language, creating a divide between those who understand the system and those who simply use it. But these terms are merely functional labels for the mechanics of moving and holding value. The foundation of any financial system begins with personal cash flow. Income represents the money you generate through labor or investment, while expenses represent the capital consumed by your daily operations, like rent, food, and bills. Beyond what you spend is what you keep. Assets are the items you own that hold or grow in value, such as a home, a stock portfolio, or even your phone. Conversely, liabilities are the debts you owe, the car loans or credit card balances that claim a portion of your future income. This relationship defines your total wealth. By taking the total value of your assets and subtracting your liabilities, you arrive at your net worth, the absolute integer of your current financial standing. Within that ledger, the most critical variable is liquidity. This measures how quickly an asset can be converted back into cash without a loss in value. Money in a savings account is highly liquid, whereas a piece of real estate has low liquidity, often taking months to sell and settle. Mastering this internal ledger is the first step. Understanding the flow of your own balance sheet is a prerequisite for participating in the larger, more complex market systems. As we scale up to the corporate level, the same principles apply, but the volume of money changes. To launch or expand, a business requires capital, the concentrated financial fuel used to drive operations. Companies acquire this capital by issuing stock. When you buy a share, you are exchanging your capital for equity, a fractional percentage of ownership in that business. A company's total value is calculated through its market cap. As this diagram shows, you take the current price of a single share and multiply it by the total number of shares in existence. That resulting figure is the public market's valuation of the entire business. Ownership offers two primary paths for profit. A company may distribute a portion of its earnings directly to you as dividends, with the percentage of that return known as the yield. Alternatively, you can sell your equity later at a higher price, realizing a capital gain on the original investment. Share prices are often dictated by market sentiment. A bull market is characterized by widespread optimism and rising prices, while a bear market reflects pessimism and decline. The speed and intensity of these price movements is what we call volatility. Success in this environment requires accounting for these erratic psychological swings. A company's share price can fluctuate wildly based on the crowd's perception, regardless of the business's actual revenue. To manage the risks of volatility, investors use specific defensive strategies. Rather than relying on speculation, betting on a price increase without data, they use diversification to spread risk across multiple industries, or a hedge, which is a secondary investment designed to offset potential losses in their primary position. Some capitalize on market inefficiencies through arbitrage. This involves finding an asset that is priced lower in one market and higher in another, allowing the investor to buy low and sell high simultaneously for a near guaranteed profit. To amplify potential returns, investors use leverage. By borrowing money against their own capital, they can control much larger positions. However, as this lever shows, the stress on the system increases. The potential for profit is higher, but the risk of a total collapse is equally magnified. When using leverage through a broker, it is called margin. If the value of the investment drops, the broker will issue a margin call, requiring the investor to immediately provide more collateral, cash or other assets, to secure the loan. Failing to provide that collateral leads to a default. This is the failure state where the position is liquidated, the initial capital is lost, and the investor remains responsible for the remaining debt. Investors can also profit from a falling market by shorting. In this cycle, they borrow an asset and sell it at its current high price. If the price drops, they buy it back for less, return the borrowed asset, and keep the difference. This abstraction goes further with derivatives. These are secondary contracts that don't involve owning the asset itself. Instead, their value is derived entirely from the price movements of the underlying cycles shown here. These advanced mechanisms decouple capital from physical assets. They create an environment where the math of leverage and the timing of derivatives can create or destroy fortunes independently of any physical product. Beyond individual trades and corporate shares lies the macroeconomic scale. At this level, we observe the massive financial flows between entire nations and global entities. Unchecked competition here often leads to a monopoly, where one entity gains total control over a market. When a few dominant players share this control, it is an oligopoly. In both cases, the lack of competition allows these entities to dictate prices to the entire population. Governments often influence these markets through subsidies, financial aid provided to specific industries to lower production costs. These interventions allow local businesses to remain competitive or keep essential goods, like energy or wheat, affordable for the public. The balance of these global interactions is measured in trade. A country exporting more than it buys runs a trade surplus. Conversely, a nation buying more than it sells runs a trade deficit, shown by this gauge, reflecting an outflow of national wealth. These flows are now globalized. Globalization is the technological and economic integration that connects these markets, allowing a banana grown in one hemisphere to be priced, traded, and sold in another within days. This global system is not a simple, unmanaged market. It is a complex landscape shaped by state policy, corporate concentration, and the continuous movement of international trade. We have traced the flow of capital from the personal ledger of income and assets through the corporate mechanisms of stocks and leverage to the macroscopic forces that move wealth between nations. The terminology of finance serves as a map for this territory. These words provide a precise way to describe how value is created, where it is stored, and how it is protected. Understanding these definitions is the baseline for financial literacy. It provides the clarity needed to observe the economy and recognize the specific mechanics at work beneath the surface.